SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Ladies and gentlemen, welcome to this SUERF-CNMV conference on corporate governance, executive compensation, and ESG goals. Acting as stewards of the investments of millions of citizens worldwide, international investors increasingly take environmental, social, and governance, that is ESG, issues into account when making their investments. The ultimate success of these investment strategies will depend on the alignment of incentives of corporate managers to ensure that financial performance on the one hand and positive contributions to society are combined. Since the 1990s, there has been much debate about executive compensation practices. Are compensation contracts designed to motivate long-term performance, or do they actually encourage managers to set high rewards for themselves, even at the cost of value generated by the firm, for the stakeholders, for the shareholders, and so on? This debate is now more important than ever, given the challenges of designing compensation based on measures of progress in ESG. We start out directly with a keynote lecture of José Manuel Campa, Chairperson of the European Banking Authority.
So again, thank you for the opportunity to deliver this keynote speech. Been very much at the front of our conversations over the last few years, and how those factors link to corporate governance and executive compensation, I think, are very, very relevant factors. And as I will speak a bit later on, areas in which we have been focusing here at the EBA for the last year. If I may, of ESG, of course, climate change-related risks, in particularly, are expected to pose considerable challenges going forward to our societies, and given what's going on in Glasgow over the last 2 weeks, the timing could not be any better to discuss those issues right now here. As you know, they have the potential not just to materialize also into financial risks at many levels and over multiple, I would say, even long-term horizons. So we need to think about them both in terms of short-term, medium, and long-term challenges. So action must be taken from a point of view to ensure financial firms now actively and effectively manage this risk. And this is key, I think, to ensure as well that financial firms can help facilitate the transition to a more sustainable economy as we go forward. Now, that transition, from our perspective, to a more sustainable productive economy requires proper risk assessment, financial stability, and a well-functioning financial system that channels adequate resources to finance the needed new investments at the appropriate cost. I think it's fair to say, and it's one aspect that I highlight all the time, we want to encourage this transition. We want to make sure that that transition to a more sustainable, productive economy takes place. But I think we need to be aware that that transition will not be facilitated, and certainly I think will also be delayed. If in the interim, trying to foster that transition, we find ourselves into situations of financial distress, of also overall financial instability. I think that in recent years, the financial sector and policymakers have stepped up their efforts to address ESG risks. This has been a very good development that has happened. Happy to hear that. And I would like to outline in the talk today how we here at the EBA consider these ESG risk factors and how they affect the banking sector, and how we're working to incorporate them into the prudential regulation of banks and the activities that we perform here at the EBA. I will also zoom in on how banks should incorporate ESG risk aspects into their governance and remuneration framework, since it's one of the key themes, obviously, of the conference today and tomorrow. Now, I would say that there is increasing evidence that ESG risks can impact the economy, and as a result, not just the economy, but more important for us, the financial system. Now, to reflect the growing importance of those risks, bank regulators are working very actively, I would say, to update and to evolve the existing supervisory framework to integrate ESG factors and risks into disclosures, into potential rules, and supervisory practices at the national level, the European, as well as the global level. I think it's fair to say that up until now, Europe has probably been at the leading front of this agenda at the global level. it's also fair to say that over the last 2 years, or recently the last year, the momentum has accelerated. I think that's a very good development. And I think it's also fair to say that as I see the scenario going forward, it's likely that Europe will continue to lead this debate. That although we're trying to encourage to make sure that the solutions are provided in a more globally and coordinated fashion, I think it's better to go ahead and move forward in the agenda rather than to wait for a global consensus until maybe it's too late. Now, ESG risk factors impact banks and the financial sector via the traditional categories of financial risk in the first place, I would say. It obviously has an impact on credit risk, on market risk potentially, on operational reputational risks, on liquidity and in funding risk as well. So in other words, from our point of view, ESG developments impact banks directly via their core activities. And as such, they have a clear link to prudential regulation like all other risk drivers. Now, environmental factors, for instance, such as increased physical risk, may result in both higher credit risk and higher operational risk. I think that's an obvious channel that we all understand very well. For example, households may be affected by climate change through increased floods, which may damage or even destroy the properties as a result of that, the value of collateral, including collateralized mortgage lending, which poses a clear risk for banks that use this type of collaterals. Corporations may also be negatively impacted by climate change-driven policy changes, not just on the transitional on the physical risk, but also the transitional risk, or by technological developments and advancements that cause certain economic activities to be phased out. On top of the climate-related risk, I would say social factors such as inequality, health, labor relations may have negative financial impacts on bank customers as well. And finally, if I may, also governance, poor governance in general, I think we have an understanding that may also have implications for financial and risk in the financial sector. Also, these examples I can think of is financial crimes such as money laundering and corruption, both pose reputational financial risk to financial system overall, but to banks individually. However, I believe that it's fair to say that at this stage, we do not have sufficiently good information and modeling techniques to properly assess how different of ESG-related risks affect the traditional financial risks. What are the channels, the causal relationships, the transmission channels, and the quantitative impacts, by which all those ESG factors may directly affect the credit risk, the market risk, the funding risk, or any other of the traditional risks. Those channels and those cost relationships are still not well established, and I would say they're even more difficult to quantify today. Additionally, we know, and I think it's important, that there could be interrelationships in those channels, and that general equilibrium effects would likely have an overall larger impact than the individual impacts of each of these risk factors when analyzed one by one. Those channels of interconnection and general equilibrium also need to be better identified, better modeled, better quantified, and as a result of that, also better management. So let me give you a few ideas of what are we doing here at the EBA to try to work on this agenda. We are working on an ongoing basis, but very actively over the last 2 years, I would say, across all the 3 pillars of the prudential framework, to develop or update the regulatory and supervisory frameworks with the overall objective at the end of ensuring the resilience of banks to ESG risks. This work that we're doing obviously is taking place in collaboration with other key stakeholders across the regulatory community, both inside the EU and internationally. I will also say, that it's taking place actively with the active participation of banks. I think banks have really become very aware of these concerns, and they are very willing to engage with the regulators, with us. And I'll give you an example of this later on how to address these challenges. Now, from my point of view, updating the regulatory framework must be done in a careful, considered manner, acknowledging that there are different challenges associated with measuring and managing the ESG risks. As I said, these challenges relate to data, to measurement, to methodology, and also to the long-run forward-looking nature of ESG risks, which poses us with significant challenges in how to properly measure them as a result of that proposed potential regulations. The key is that ESG risk drivers are likely to become more important in the future, so we need to start working now to make sure that we address those. And I would say this particularly so for all ESG drivers, and probably less for environmental risks, because those are already present with us in a very tangible manner. So I think fiscal risks have increased and will increase in both frequency and severity. while changes in behaviors and future policies will also change, and that provides an enhanced transition risk that we need to be aware of, conscious, and ready to model and manage. So I would say that our work is being guided by several mandates that we have received from the co-legislators. Some of them were directly from the European Commission, some of them come from level 1 legislation. We are at this stage, updating most, if not all, elements of the regulatory toolbox, including, as I said, prudential regulation, stress tests, and reporting standards. But for us, this work follows what we consider to be a sequential approach and a natural sequential approach. I would say, that sequential approach for us starts with enhancing Pillar 3 disclosure, and then enhancing risk management as part of the Pillar 2. And that should be and has been the priority that we have put in this first phase of our analysis. I think this is justified by the present need to enhance disclosure of comparable metrics informing banks' strategy and also the bank's risk profiles, as well as a more assertive integration of ESG risk considerations into the business strategies and the risk management of individual banks. Concretely, in Pillar 3, I think that Pillar 3 rules will be key as a transparency. It's a key driver for market discipline always. Disclosure of information by banks and by their counterparties on ESG factors, I think, plays and should play a crucial role in tackling the challenge around the lack of ESG-related data. We need to acknowledge that at this current juncture, the lack of data is challenging for banks. And we expect that these regulatory disclosure requirements should help us in enhanced market discipline, should help us in how banks identify where those data gaps are, and also should help us to understand and recognize that we have those data gaps and we need to work further to make sure that we try to fulfill them. But additionally, I think it's important, we also believe that the banking sector here can play an important role as catalyst for disclosure across the productive sectors. The banking sector reaches all sectors of economic activities. It has interactions with all industries in all sectors. So if the banks increase their demand to their customers for disclosure from customers on ESG-related risks, I think non-financial corporates and households will also accelerate their own awareness and adaptation to these risks. And as a result of that, they will actively manage them, facilitating that transition in a more risk awareness manner. So in this context, we have put forward for consultation disclosures on Pillar 3, and we expect to publish Pillar 3 ESG disclosure requirements in the near future. I would say that probably within the next 3 or 4 months, with the expectation that those disclosures will become requirements for banks in 2023, with information of the end of 2022. At the same time, we will continue working with the European Commission in the implementation of the taxonomy, what we call the Article 8 of the taxonomy regulation, as well as all the many other initiatives around transparency and reporting in the ESG field. One of the announcements, as you know, last week in the context of COP26 was the creation under the IFSR Foundation of a new body that will help in developing global standards in the ESG-related area. This is an area in which we have been very supportive, and we've been pushing to try to make sure that it goes forward. So I'm very happy that actually has materialized, and I have high expectations that will help us also in enhancing the broader sense of transparency that needs to be provided in these issues at the global level, and by global I mean both across all sectors of the economy and across all jurisdictions in the world. So that's one area. If I may now move on to Pillar 2, and here in Pillar 2, I think in terms of risk management in the Pillar 2, we see the need for further embedding ESG risks into banks' business strategies, into the internal governance arrangements, and the risk management frameworks, very much in the core of the content of the sessions for today and tomorrow. This means for us that actions need to be taken by banks in a timely manner to build their resilience to ESG risks. Includes adopting a longer than usual time horizon, for instance, for strategic planning, for testing resilience against different scenarios. I think that we need to go beyond the standard 3-year horizon that's being used in many of the testing. Also, they need to identify better the drivers of financial risk, they need to identify what the risk appetite should be and how they're going to do internal capital allocation process and resources to different parts of their business as a function of this risk. I also think they need to enhance their methodology skills and testing skills for risk management. We need to move more into forward-looking scenario analysis rather than just base our approaches in historical time series of past performances. Now, ESG risk, I think, will also need to be incorporated into the supervisory practice of supervisors, starting with the assessment of the bank's internal risk management and governance frameworks, as well as the business model risk analysis from this perspective. This direction is already reflected in a report that we published on ESG risk management and supervision last June. And the next step from our point will be to create more concrete guidance to supervisors, and we will update what we call the SUERF guidelines. We provide supervisory guidelines on how to do the supervisory evaluation process to harmonize supervisory practices in this field, and we'll probably publish this by early next year. Finally, if I may, the third pillar, in Pillar 1, by the way, I'm using this terminology of Pillar 3, Pillar 2, and Pillar 1, which is very standard in the context of the banking sector. If it's not familiar to many of you, Pillar 3 has to do with disclosure, Pillar 2 has to do with risk management and internal governance, and Pillar 1 with prudential capital requirements, what we normally refer to as Basel III. So now, in terms of when it comes to Pillar 1, from our point of view, and this is very important, above all, we should have a careful and well-considered approach that needs to be taken and based in a proper risk management and risk evaluation of the risk assessment related to ESG risks. It is a key for us to ensure that the prudential requirements are evidence and risk-based. So that's why we think the first is much more important to have enhanced disclosure, better risk management. Once we know what a good assessment of the risks are, then it's the time to think about a proper Pillar 1 requirements. Now, in that context, gathering evidence on environmental risk drivers, I already say it's challenging, but we need to continue to work forward. It's not challenging just from the point of view of lack of data. It's also challenging from a methodological point of view, because we'll have to take more of a forward-looking nature of this risk, that again, rather than just base our modeling techniques in historical time series. And we should also be aware that some of these risks may already be captured in the Pillar 1 framework. So to the extent, as I said before, to the extent that many of these risks related to ESG-related aspects will channel into the banks through traditional risks, be it credit risk, be it operational risk, be it reputational risk, those are already covered in our Pillar 1 framework, so they might already be embedded in there. We're currently preparing a discussion paper on this topic, which will seek to identify key questions and areas for further work. We expect to put this forward in the first quarter of next year and get broad feedback on this, with the idea of move forward probably in 2023 with this agenda. Now, if I may, I'd like to go to another part of our own work, which is very much embedded in ESG risk, in which we need to upgrade a lot of our techniques and methodologies, which is the area of scenario analysis, risk assessment, and stress testing of banks, which is one area which, as you know, the ABA has a significant mandate. As I said already, a key degree here of uncertainty comes from the forward-looking perspective that is required to adequately measure this risk. For us, here, the development of new tools, more appropriate tools and methodology in the context of environmental-related stress testing and scenario analysis, both by bank and supervisory authorities, will be key. And here, I think that researchers here in our research conference, researchers have a lot to contribute to help us enhance on that methodology assessment. That's a significant change in the approach that so far has traditionally been taken in stress testing, which is based, as you all know, in basically historical time series and doing a projection or a macroeconomic projection of a certain horizon, usually around a 3-year horizon. Here we need to think much more broadly in broader scenario testing and probably much longer horizons. We have recommended banks already to continue developing methodologies and approaches to test their long-term resilience to ESG factors and risks. And also, as I said, to enhance the use of scenario analysis. And we expect to provide further guidance on this by the beginning of next year. As you know, supervisors have been using also these techniques to try to do climate stress testing and scenario sensitivity. We have ourselves early this year published the results of a first pilot exercise on climate risk, in which we counted with the help and the support of a sample of 17 volunteer banks that were willing to engage with us. in this scenario analysis. What we did really at this stage was to get a sense of how difficult and how likely were investors and us to be able to map banks' exposures, existing exposures against the ESG taxonomy, and at the same time shed light on what the data and the classification challenges could be there for banks to be able to provide that information. We only did this exercise for non-financial corporates, excluding SMEs and excluding government exposures. So, and even in that context, the difficulties were very large. As we go forward, I think further developments are going to be needed to this front, particularly, as I said, the area of SMEs is clear, and also, and in that part, I think that next year we'll be able to come forward with additional guidance, but also in the area of public exposures and sovereign exposures, where progress that is probably much likely to go slower. Now, we have new mandates coming from the Commission in this area, including the development of methods and scenarios, and also the requirement to run a coordinated stress test with the other two ISAs, with the ESMA and EIOPA, in the overall financial system. Because, as I said before, one of the characteristics that we see that is common on the challenges from the ESG is the general equilibrium component of it, and the importance of doing a general equilibrium analysis rather than not doing a sector analysis or a bank-by-bank analysis, and we do a bank-by-bank analysis. Now, if you allow me to, before I conclude, I'd like to do a little bit of a deep dive on how we view integrating ESG risks into governance and remuneration practices of banks, given that this is one of the key topics that you guys will be discussing later today and tomorrow. We consider that the internal governance orientation of banks, including the involvement of the management body in establishing a risk culture and setting the risk appetite and implementation of a robust internal control framework, as I mentioned before, those are crucial aspects. Those are key aspects for a successful implementation of ESG considerations and also of the management of ESG risk. As we like to say, tone from the top is very important, and these issues is probably more important, even more important, given their nature and their long-term implications. So here, let me start by highlighting that remuneration in the banking sector, which is one of the issues that you have in your component. It's already subject to a number of important requirements to try to align remuneration profiles with the risk profile of the institution and with long-term performance. And that's a good starting basis. The establishment of the fair remuneration, the linkage of part of that remuneration to the behavior of equity instruments in the bank, the existence of bonus, maluses, clawbacks, which are already well established, I would say, in the banking industry and effectively being implemented. We already have examples of clawbacks being used, or balances being used. Those are all mechanisms that are already in place to better align long-term risks and performance with top management remuneration. I think that's a very good starting point, which the ESG factors should be embedded as well. Now, so that's sort of like the good news. Now, the not so good news is that given current market practices, we see 4 areas of shortcomings in internal governance arrangements in relation to ESG risks. And I said these 4 areas are broad generalization of the status of the banking industry, and there's a lot of progress that's been done by banks in some of these areas, so it might not apply to every single bank, all of them. But the first one is that for many of the banks, and this is changing, particularly large international banks, environmental and social governance programs exist, but many of them are designed within the context of the corporate social responsibility perspective, rather than being core features of their management and business strategy. And that needs to shift. I think that we think that there needs to be a shift from just viewing these issues as part of the corporate social responsibility strategy of the bank or the institution to being, as I said, core features of the management and business strategy. The second aspect is we think that there's a shortage of knowledge and skills specific to ESG risk across banks. And this is, I must be honest, I don't think this is just exclusive to banks. I think it's also something that probably can apply as well to Supervisory and even to the ABA ourselves. We have a lot to learn here, and we need to develop a lot of expertise. I think that, but on the not so positive side, I think that despite this lack, we do not see sufficient emphasis on trading in these areas across the institutions. The third aspect is also we don't think that they're very good practices, so they're just beginning, but they're still very incipient practices for effective third-party risk management of these issues. The banks do not or cannot carry at this moment exercise to collect sufficient and accurate data on their customers, on their counterparties with respect to ESG factors to really address this ESG risk. That's why we think that Pillar 3 disclosures, as I said before, could be an exercise that will help be a catalyst in that direction. Furthermore, I think that the development of relevant metrics and KPIs for effective management of ESG risk factors is still missing. Fourth, I would say that ESG factors are not sufficiently integrated into the company cultures in general. Remuneration policies, as I said, they have made a lot of progress in making them more of a longer-term horizon, more built into the overall risk profile of the institution and the long-term performance of the institution. But I think that specific ESG risks are not sufficiently accounted for and do not contribute enough to ensuring some ESG risk management and mitigating excessive risks in this area. So given these shortcomings, we see the need for banks to proportionally increase ESG risk into the internal governance arrangements. For us, this should cover the management body's responsibility, and as I said at the beginning of this part, it's tone from the top. The institution needs to have a clear tone from the top of this area. Also should include the allocation of tasks and responsibilities related to ESG risks in decision-making progress, with proper committees and proper decision-making being identified. Provide internal capabilities and arrangements for effective risk management. As I said before, training here I think is important. And then finally, remuneration policies that not only are aligned with the bank's long-term interests, but that explicitly take into account these ESG components. I think that banks can achieve this by establishing clear working procedures and responsibilities for business lines, for internal control functions, for having relevant committees, and also, of course, at the level of the management board. The regulatory framework has recently been updated in this direction. We published revised guidelines on internal governance in July of this year to clarify that banks and their management bodies should take into account all the ESG risk, and we expect that these guidelines will be enforced and implemented going forward. Now, with regards specifically to remuneration, we published actually revised guidelines on this matter in July, which clarified the bank's remuneration policy should be consistent with the ESG-related risk objectives and strategies. So we hope that going forward also that will be improved. So let me conclude, since I've already been talking for a long time. I think that the need to transition towards a more sustainable economy will surely spur new business opportunities, but will also expose financial institutions to risks that may arise from this transition. Some of these risks, I think, only materialize over the medium to long term, but action is needed now by banks and by supervisors to progressively start implementing the necessary steps to manage those risks as they arise. The efforts that we're making here at the ABA that I have described are designed, I think, to support the incorporation of ESG risk considerations by supervisors on banks. I hope that we're going in the right direction and that we're helping to safeguard the resilience of the financial sector, not just in the short, but also in the medium and the long term. But I also think it's important to ensure that banks are well positioned to effectively address those ESG risks. Also, coming back to the important role the research has to play in this field, the assessment methodologies, the quality of transparency and meaningful disclosures, and what is proper and well risk-based measurement and prudential management of this risk requires new modeling techniques, proper assessments from my point of view, as I said before, more forward-looking assessments and more general economic assessments. So I think here the contributions from the research committee, I think, will be particularly important. So I hope that I have been able to give you an overview of how we see the ESG risks from the ABA's point of view, and how do they matter to the financial sector and to the banking sector. And I look forward to learn from you and to the debate to further learn in this area, because as I said at the beginning, this area which is an area which we all need to continue to contribute. Thank you very much for the invitation again and for your attention.
Thank you very much, José Manuel, for this very interesting presentation. Meanwhile, Jordi Gual from IESE Business School, non-executive chairman of VidaCaixa and a SUERF fellow, has managed to join us as well. Jordi, the floor is yours.
Thank you very much. Good afternoon to everybody. It's an honor to be with you. I have to comment on ESG goals related to corporate governance and compensation policies, the subject of this conference. It is fitting since the Glasgow COP26 meeting ends tomorrow, that I focus on the environmental aspects. Now, on the climate change transition, which is a huge challenge for the world economy. We economists tend to believe that the first best policy, we think we know what it is. It's a collection of taxes, subsidies, and public warranties that should be agreed at the international level, and that could face this daunting global collective action problem that we have. But the uncertainties are amazing, huge. Uncertainty about the current technologies' effect on climate and the prospects of new technologies and what they can do to abate and capture CO2, or to have more efficient, more technologies that emit less CO2. If this first best policy were to be implemented, finance and investment of those challenges would go smoothly, but we know that will not be the case. This is not going to happen, and with luck, we are going to have a very messy climate change transition where policymakers and the private sector will interact, and will be a complex interaction, and decisions will be taken by the different actors, most likely not along the lines of our first best choices, but rather with direct regulation and quantitative interventions in the markets, and with very imperfect indicators of ESG available to the players in the economy, and of course with high likelihood that it will be very hard to discern greenwashing from actual actions that reduce the externalities involved. Now, in this such an imperfect world, there is a huge temptation, I think, by politicians to use all policy tools available so that we can confront this urgent problem quickly. And that, I think, would be a mistake. That, I think, should not be the right way to go. The right way to go is to establish the priorities correctly, even if it is not the optimal policy. And in the way I see it is that we should try to satisfy three fundamental goals. First, to get quick wins in this challenge, tackling the least controversial technology, and making sure that we can have moderate costs to compensate the losers. So that we can remove those technologies where it's less controversial, that they should be removed. The second is to ensure that this is a politically viable transition, so that we can compensate the losers and we do not face short-run energy shortages. And third, that we send the most effective signals to the technology market so that we can get good transition towards more efficient technologies and disruptive technologies that can reduce the cost of emissions. Now, policy tools in other areas, such as the microprudential regulation of financial institutions or the corporate governance of and executive compensation policies, could possibly play a role in all this complex scenario. But I think that it would be ill-advised to use them for ESG goals, because in using them, we could jeopardize the main objectives of these policies. I don't know to what extent José Manuel spoke about this, about microprudential regulation, not in the part of his talk that I could listen to, but the conventional take of economists, I believe, is that climate transition creates new risks associated to both physical and policy transition, and that the proper way to proceed is to incorporate those risks in the risk assessments of the institutions and maintaining the power of the policy tool in a new economic environment characterized by new and important risks. The capital requirements of banks are supposed to include equity available for all unexpected losses, including those arising from these new risks. they are not designed to be instruments that channel the lending action of banks, even if, of course, they influence the lending outcomes. Therefore, I do not support an ESG supporting factor, since it could jeopardize the main goals of the policy itself, which is to preserve the solvency of individual institutions. What about executive compensation policies? Well, the proper goals of these policies are twofold. On the one hand, they aim to align the actions of managers with the goals of the company to alleviate the agency problems. And relatedly and more specifically, they attempt to make sure that risks are under control, because this is an area, the risk, where discrepancies between managers and owners are hardest to monitor. As it is well known, there is a delay between performance and pay precisely for risk purposes, to ensure that the full consequences, short and long term, of the actions of management are considered. It is clearly the case that adding ESG factors may alter the goals of the company as well as the risks that management must consider. Therefore, those goals and risks could form part of the ESG policy of the firm, even if both are not always easy to measure. This also means, I believe, that the interaction of executive compensation policy with ESG goals must be approached within the broader discussion of how a firm incorporates ESG goals in the business model and its strategy. Imagine for a moment, bear with me, a world where you have two types of firms. One type 1, say, it's a firm that maximizes profitability, long-run profitability, or shareholder value. They consider ESG goals as restrictions to their objective function, and compliance with those restrictions is imperfectly observable, since, as we all know, we don't have non-financial accounts which are the equivalent of the financial accounts which we use for financial goals. Risks will be considered to the extent that they are private risks, unless, of course, regulation forces the firm to internalize those externalities. The other type of firms, type 2 firms, so to speak, have goals that go beyond profitability and serve a purpose which typically encompasses ESG, environmental or social goals. These goals are established within the firm, although they could refer also to external benchmarks. These firms are often called stakeholder firms. And one can think of these firms as firms that require profitability above the cost of capital, but have other goals. And they have to compensate the managers in a context where they have the challenge to distribute the surplus between all stakeholders. The constituencies between ESG goals have a claim on the performance of these companies, with goals that are quite likely to go well beyond the benchmarks established by government agencies. And in principle, this type of firms will internalize, at least partially, some of the externalities and the associated social risks. Of course, in our economies, most of the firms are of the first type, profit-maximizing firms. And the question is whether, on top of the complexity introduced by the regulatory and market restrictions related to ESG, one should go ahead and intervene in the compensation model, trying to add ESG objectives. This is a very difficult question, and this is the topic of this conference, and I will only make a couple of personal remarks on this. The first is that adding ESG compensation targets, I believe, will reinforce some of the shortcomings that I see in current compensation practice. Compensation is typically linked to many indicators apart from the bottom line. It is already too complex, in my view. When we add ESG, it may become even harder to manage and understand. with too many targets, and most of them not quite reliable. It will become more complex and more obscure. What we are lacking here is a more holistic view, one which arguably could be achieved if the ESG goals are part of the purpose of the company and not just a restriction. Another feature of ongoing practice is that some of the indicators that determine compensation are tied to the relative performance of peers. This is already fraught with difficulties, and in my view, it will be even harder if we add ESG objectives where the stance of companies is likely to be quite different. My second and final remark is that if we must consider ESG goals in the corporate governance and compensation policies of companies, this clearly makes it imperative that we allow companies with a stakeholder approach to compete on the same footing, rights and obligations, that companies that pursue shareholder value. Stakeholder companies will usually have a longer time horizon, will incorporate ESG goals and risks within purpose of the company, and manage compensation to the different stakeholders in a more holistic perspective. We should allow these alternative enterprise models to compete in our economies on a level playing field. And this means changes in the legal frameworks and in the property structures that make these type of models viable in the marketplace nowadays. And with this, I conclude, and I hand it over to you, Ernest, and thanks very much to all of you.
Thank you very much, Jordi, for these very substantial introductory remarks. Meanwhile, we have received quite a number of comments from the participants. There are two questions relating to social aspects of ESG. One is the aspect how ESG compatible it is if banks close their branch offices and make it more and more difficult for people in rural areas to do bank transactions. And the second aspect is, to what extent is ESG responsibility compatible with many banks' tendencies nowadays to reduce their staff? I mean, banks are challenged by digitalization and so on, by cost pressures. So to reduce their staff and to lay off, for instance, older workers.
Both of those questions to me point to in the same direction, which is that, and they're both directed to banks, and they both refer to the fact that banks are confronted with a challenge that's driven by technology. And that challenge by technology, which offers a lot of opportunities, by the way, it's something that they need to adapt to, and they're engaging in different strategies to adapt to that, and that basically involves, you all know what it involves, but fundamentally involves eliminating some of their existing distribution network for more digital distribution networks, right? And at the same time, maybe rechanging the composition of the labor force, and sometimes even reducing the labor force if needed. That's no different from the demand that is being confronted in many other areas of society for industries that have been imposed to intermediation, right? And I think on the first aspect, which has to do with exclusion, I think of the first question, I think this is an important aspect that we've been highlighting. It's true that traditionally, we're concerned about inclusion of societies in less bankerized countries, particularly in emerging markets, making sure the financial service approach of financial service arrived to a number of population. Now it turns out that ironically in the developed markets in Europe, where we have a large degree of bancarization, we're concerned about exclusion or inclusion, from people that may be left out of the market after having participated in it. Now here, I think that there are two points I would like to highlight. The first one is that to a large extent, I think that, the closing of branches does not result in the non-provisional services. They just get provided in a different manner, through the digital agenda. And it's not clear that rural areas, for instance, have difficulties accessing digital in general because the degree of penetration of the digital networks has already compensated for that. It's a more concern potential for exclusion for less digital parts of the population, particularly the elderly population. And that's an area in which I think that the work needs to be done. And I hear many times that banks are taking care of that by making sure that they provide adequate services. But that's an area of concern for sure. But I think that any bank will be at the same time aware that they don't want to lose profitable customers. And if those customers are attracted, they will find ways to serve them. Now, on the second aspect of the technology, I would say that the banking sector, the banking sector is in need of a significant industrial restructuring due to technological demands. And that industrial restructuring is no different from many industrial restructures that have taken place in other sectors of the economy. So I don't think there's any incompatibility in doing that restructuring with at the same time being concerned, of the well-being of the workers that are being left. In fact, compensation packages in many of these restructuring processes tend to be much more generous than the outstanding social network that exists in those economies. So in that sense, they're being actually, I would say, conscious of that process. But it's a demand that's driven by technology, from the way I view it.
Thank you, José Manuel. Jordi, what would be your answers to these questions?
Very much sympathize with the way José Manuel has approached it. And I will tie it to my intervention. I think that, and of course, I've been for years in a financial institution, which to a large extent is based on the stakeholder approach that I discussed in my intervention. In such an approach, and I continue to have ties with this institution, and such a stakeholder approach allows you to, in counting as your investors in the financial markets with patient capital investors with a long-term horizon, allows you to take a holistic view, a comprehensive view, where you, of course, have to satisfy long-term financial investors, but at the same time, you earn a license to operate in society by providing financial inclusion, and you devote part of your resources to guarantee that is satisfied despite the closing of branches. You implement and you maintain branches with social goals for social purposes. And that gives you a license to operate, and it satisfies society, which is one of the stakeholders in the company. And the same goes for the needed restructuring to which José Manuel was referring to. I mean, the relation of a stakeholder company with the employees and the professionals that work in the company, it's a long-term relation based on the commitment of the two parties. And if the technological circumstances and the evolution of interest rates drive to a contraction of the industry, one has to reduce the size of the labor force, but that can be done in a variety of ways. And as José Manuel has highlighted, the compensation packages have been substantial, and it has been done, at least in the case of our institution, on a voluntary basis, right? So I think that sends the right signal that it's part of this mutual commitment of within the organization between the company, the organization, and the employees, which have devoted substantial efforts to creating the value of the organization itself.
Thank you very much. I have two related questions here, which somehow are linked through the idea of non-linearities and sudden developments. So it is again addressed to both of you, I would say. So how to deal in, let's say, stress testing or in risk provisioning with non-linear events, for instance, with a sudden change in investor sentiment against brown sectors. You know, investors are subject to herd behavior and sudden mood changes and so on. So what if there is a sudden change in investor appetite towards brown sectors? And related to this, do you see the risk of a bubble in green assets at this point in time or emerging?
If I may, on the second question, I think that is clearly a concern. I would say there is a concern that the amount of investable green assets may be perceived to be maybe growing less fast than the demand for those assets. You know, I think that that's clearly a clear concern. That's why I think it's important that we need to continue to develop clarity and a speed on that transition towards those green assets, so that the supply keeps up with the demand. Whether that has reflected in a significant asset valuation, I'm not in a position to be able to tell you, whether it's about or not. But I think that's clearly a concern. We need to make sure that we keep up. It's very good that we have developed a significant amount of consciousness among the investor base for their willingness to allocate part of their investments into green assets, but we need to make sure that the supply of those assets are also in place to be able to satisfy and to avoid the creation of excessive demand. I think that's very important.
Thank you, José Manuel. Jordi.
Yeah, no, to complement, I think that it's important for this question that work continues on the taxonomies, that we clarify the real green or brown content of different assets, because there's quite uncertainty on that. And then the first part of the question, which has to do with sudden change in sentiment towards brown, precisely that's what bothers me regarding the comments that I made at the beginning of my introduction. Because I think that that would be, I mean, that sudden sentiment change towards brown could happen because of the incorrect design of the transition that is taking place, and the fact that investors, for lack of strong references coming from authorities, anticipating the wrong way and precisely create trouble in the transition by shunning brown sectors, which may be needed still for a while to guarantee that shortages do not take place. So that's why my sense of urgency that the key first best policies or close to that should be implemented. And I feel that there is a temptation to ask the finance sector to react when we still have to agree upon the measures that should be taken in the non-finance sector, which to me should be the priority. It's taxes, it's carbon pricing, it's subsidies that should go first, not manipulating the finance sector to achieve the transition goals.
Thank you. This has been very clear. I thank you very much, José Manuel and Jordi, for your insights. It's really a privilege that you took the time to share your thoughts with us.